welcome to the weekly Route Consultant webinar. For those of you who are here for the first time, my name is Josh Gregory. I am one of our consulting directors here. For our regular attendees, welcome back. This is always something to look forward to every week. This is something where we try to have a lot of fun, also give you guys some knowledge. So the way it's going to work is I'll talk through some content at the beginning, but then we will have an open Q&A for anything you can think of to go through any questions you have and make sure they're all answered. I will be co-hosting today with Bridget. She is one of our consultants here on the team that helps guide buyers through first acquisitions. So as we get into the Q&A later, I will bring her on. Now, before I get started with all the fun stuff, I have to read a quick, little bit boring disclaimer for you. So Route Consultant is not endorsed by and is not recommended by Federal Express Corporation and FedEx Ground. Route Consultant is not sponsored by, is not approved by, is not associated with, and has no connection whatsoever with Federal Express Corporation or FedEx Ground. So again, that is not anything important. All it really means is that you will not hear any materially non-public information here today. But again, we do hope you hear some valuable information that comes from our team. So before I get into content, just a couple of upcoming events that I wanted to alert you to. So next week, we have a virtual summit for new investors on Monday and Tuesday. So if you haven't attended one before, I would highly encourage you to attend if you're a new investor trying to learn about the space. There are only a couple of spots left. So if you miss the one next week, you will not have another chance until July. So look into that, ask questions, reach out to the team if you have any questions there. This weekend, so Friday, we have a roadshow out in Raleigh, North Carolina for any contractors in the area. So if you are interested, it'll be a great time. We're also going to take a trip out to the Morgan Olson plant to get to see everything there. So if you are in the area or anywhere close, just feel free to reach out to the team. We'll give you some info. We also have another happy hour coming up in New York City on June 2nd. So if you're up in that area, we don't always come up to the Northeast, so it could be your shot to meet the team. So another thing here is that when we get to the Q&A, there is a very important tradition here where in order to ask your question, you have to first answer one of our questions. So when we get to the Q&A, you will type your question in the Q&A box, not the chat, type it in there. And the question you will have to answer first is, what was your high school mascot? And also, did they wear a full outfit? Any fun stories around your mascot? So Bridget and I will answer that at the end or before we start Q&A. And then all of you will need to answer that question as you're typing it in the Q&A box. So make sure, again, Q&A box, not chat, or we will miss your question. So the topic for today, we have been talking a lot about financing options recently when you're looking at purchasing a FedEx business. But I want to talk a little bit about another financial question that I get all the time. So once you have found a business and closed on it, how much working capital do I need to be successful? So at the barest level, the minimum and our general recommendation across the board is you need to have $75,000 or 6 months of debt service payments, whichever one is larger. So this is a cushion to have additional liquidity when you're first entering the space. That being said, I would say the most worry around working capital comes in those first few months of operation. So while that is kind of just the general number we tell people to have, I want to talk through some of the expenses you should be thinking about when you're first starting an operation and how it can impact your working capital. And then once you've kind of internalized those, you can start to model it for the specific business you're looking at purchasing and thinking about so that you can apply it beyond just the general. And it is the minimum of $75,000 or 6 months of debt service. So just at the barest level, I would say you actually need a surprisingly low amount of working capital in those first few months of operation. The biggest one, just to make you aware of, the biggest expense you'll see is payroll. So the way it works with 98% of contractors is that payroll is paid 1 week in arrears. So when you first take over that business in the FedEx space, you will not be paying payroll for the first week. Those drivers are still owed a week of payroll from the previous contractor. That should be the standard, but it's important that you have a conversation with the seller about the fact that the first week of payroll is still on them to pay. It should also be a part of your contract, but it is very important to be aware of and make sure you talk about it with the seller. Like I said, it should be the standard, but you don't want to assume anything there. So you will not have to pay that first week, but then you'll come to the second week. So the way FedEx will pay you is that they will typically pay you 1 week in arrears as well. So you will get your first paycheck from FedEx on a Friday, but most payroll companies will deduct payroll out of your account on Wednesday, the Wednesday night at midnight, sometimes early Thursday morning. So what that means is that payroll comes out on Wednesday, you get paid on Friday. So in that second week, you're essentially going to have make sure you have enough working capital to cover that second week of payroll, since there's going to be about a day that you have to float in which you have paid your payroll for the week, but you have not gotten your first check from FedEx. So that's really one of the biggest working capital considerations in the first few months of operation. Generally, it's not a lot of money. You can look at the current weekly payroll of the business and plan for that amount. I'll also say that there are some payroll providers that will allow that payment to come out Thursday night late, which lets you avoid that float period. So it's a good question to ask your payroll provider. But in general, that's something that you should just be aware of and make sure at minimum you have that amount in that first or in that second week of payroll. The next major expense that you'll run into in the first month or so is fuel. It's going to be an expense always, obviously, but the one for working capital you want to make sure of. And the thing to know about this is that if you're using a fuel card, or a lot of you will use credit cards, is that in general, you can have really favorable terms around paying back those fuel costs. So especially if you use a credit card, it'll be just like a normal credit card where you charge it during the month, you'll get a statement 5 to 10 days later, and then you'll have about 15 days to pay it. So you can realistically have as long as 45 days before you have to pay anything around fuel cost. And by that time, you will have gotten multiple weeks of settlement statements, the paychecks from FedEx. So you should have kind of your war chest built up a little bit more than just the working capital you're bringing to the table. The next major expense is repair and maintenance. Now, the first thing I'll say is that a lot of the times, if you do incur a higher amount in that first month or two, it could be because you didn't get the vehicles inspected and you run into some repairs that you weren't expecting in those first couple of months. That's why it's really important to get a vehicle inspection to make sure you know of any repairs before closing. But that being said, a lot of mechanics will allow you to pay on payment terms instead of just paying it at the time of repair. Sometimes I've seen as long as 45 or 60 days to pay that back. So it is a good question in your due diligence to ask the seller what kind of terms, payment terms that they are currently getting from their mechanic, and then see if you can get similar terms or at least know what to ask for and try to negotiate around if you can. The next major expense is insurance. Most insurance will bill monthly. Some will bill weekly. Some will bill annually. What I will say is if you do monthly, you'll get, again, at least several settlement statements before you have to pay that back. So those are really the biggest expenses from a day-to-day perspective that you incur in the business. And I want you to just start to already think about the different options you have to move your payment terms around and see what kind of flexibility you have. You should have it in all of these areas, but asking the seller and getting some advice on each particular vendor will let you know exactly what kinds of flexibility you have when you get to that point, so that you can have at least a kind of a buffer in these first couple of months. Really, the only significant guaranteed amount that you'll truly be pulling on your working capital for is that payroll amount where you have to float it for a day or two. Besides that, there are a couple of startup expenses to be aware of that you'll incur pretty early on. In some states, you'll have to pay sales tax on the vehicles that you purchase, which is a potential cash requirement that you'll want to consider depending on your state. Make sure you have that in reserves. There are some filing fees depending on the state, and there's also some prepayment of unemployment insurance depending on the state. But overall, those should not be huge costs. So overall, the cash flow challenges in the first few months of operation should not be significant. And if you can buffer, kind of get through those few months, you'll have enough settlement statements where you should be able to kind of keep the liquidity of your working capital in reserves and not have to depend on it too much, but really just be pulling from the business to pay for expenses at that point. And like we said at the beginning, the minimum you should shoot for is to have $75,000 or 6 months of debt service, whichever is higher. Now, one other thing is we are huge believers in securing lines of credit. So if you have a home or some kind of rental property that you can secure a home equity line of credit on, or just in general, some kind of business line of credit, that'll give you a lot of confidence early on and a lot of liquidity that will allow you to focus on operating the business in those first critical months. Ideally, I would not want you to spend too much time focused on your P&L or the profitability of the business at the beginning of operations. You will have, like I mentioned, some of those startup costs at the beginning. You will have stay bonuses. You will have sign-on bonuses. There's several different things in those first few months where it is not going to be a good indication of the profitability of the business in the long term if you're just focused really closely there. So the point of all this is to know kind of a minimum of what you need to be comfortable so that you kind of have that level where you're not going to be super concerned that you're not going to make your debt service payments in the first month. But I really want you, when you're thinking about entering the space, to give yourself a break at the beginning and then just focus on learning the operation in those critical months and focus on setting up a culture and a company that you want to have in your new business. So like I said, this is a question we get all the time. There's a simple answer of the 75,000 or 6 months of debt service, but I just wanted to spend a little bit of time here to try to address the concerns I see people have in those first few months of operation. What should I expect? What should I prepare for? So that is it on the working capital side. If you've got questions, we're going to go over the inventory, but feel free to start to load them up in the Q&A. And as a reminder for everybody, the question of the day this week is, what was your high school mascot? And then did that mascot wear a full costume? Do you have any fun stories from that mascot? Again, put that in the Q&A, but I will bring Bridget on now to start to talk through the inventory, the new listings that came out this week.
All right, thanks, Josh. Well, we had 13 new listings go live on our public site this week. So we'll get started with one out of Bowling Green, Kentucky. This is a 10 P&D route operation listed at $250,000. That's right at 25% of revenue. This is currently operating around a 10% EBITDA margin. It comes with 2 managers and 6 spare trucks. This has a great roster of reliable and efficient drivers. The sale also includes 18 scanners. And then there's going to be $480,000 in truck debt that needs to be assumed by this new buyer in addition to that purchase price. They have a relatively new fleet based off of that truck debt. But next one is out of Newburgh, New York. This is going to be a carve, and this is 9 P&D routes. This is listed at $1.4 million. That's right at 114% of revenue. This one is currently operating around a 21% EBITDA margin. This comes with 1 manager and 4 spare trucks. This has a rising population and economic development in Newburgh. So definitely some growth potential there. Strong and consistent growth margins. And is a dense, low mileage operation there in New York. Next one, or next 3 actually, are out of Macon, Georgia. The first one is a 10 P&D route operation listed at $925,000. That's right around 76% of revenue. This one's currently operating around a 15.5 EBITDA margin. This one should be SBA eligible. It does come with 1 manager and 2 spare trucks. And this business is going to come from a contractor with over 15 years of experience in the FedEx space. This has consists of very dense routes. So that's going to help offset costs of fuel, repair and maintenance costs on your vehicles. And this has a great roster of independent and efficient drivers. This sale also includes 10 scanners. That's again in Macon, Georgia. The next carve out of Macon, Georgia is a 14 P&D route operation. This one's listed at $900,000. This is putting it right at 61% of revenue. This one's currently operating around a 12.5% EBITDA margin. This one too should be SBA eligible. It does come with one manager. It's going to come from that same contractor with the 15 years of experience in the FedEx space. So really valuable there for transition support. And again, consists of dense routes that's going to provide relief from capital expenditures. Same great roster of drivers, and this sale includes 14 scanners. All right, the next one is out of Kingsland and St. Mary's, Georgia. This one is 8 P&D routes listed at 1.1 million. That's right at 95% of revenue. This one is currently operating around a 19% EBITDA margin. This too should be SBA eligible. It comes with one manager that's been with the business for over 10 years, super valuable. This again is the same contractor as before with over 15 years of experience. This portion of the sale is going to come with 2 spare trucks, another great set of drivers. This is a more rural territory. This is going to offer some easier routes. And believe it or not, these rural territories actually have lower turnover for your drivers. So that could be a real benefit there. And this sale includes 8 scanners. The next one is out of Rogers, Minnesota. This is 8 P&D routes listed at $825,000. That's right at 81% of revenue. This one is currently operating around a 16 to 17% EBITDA margin. This one is also SBA eligible. It also has assumable truck debt as an option for some creative financing. It also comes with one manager and 3 spare trucks. It has an improved fleet that's going to offer some better efficiency and reduce repair and maintenance costs. And these routes service residential high growth territory. This sale also includes 12 scanners and 12 tablets. Another one in Georgia. This is going to be out of Atlanta. This is 15 P&D routes, currently listed at $975,000. That's putting it right at 61% of revenue. Currently operating around a 13 to 14% EBITDA margin. This one comes with 2 managers, one serving currently as the BC. This one comes with 1 spare truck, and the fleet is going to be comprised of newer model vehicles. Again, increasing efficiency, better with fuel prices. This territory is going to be low daily miles and dense routes. So again, that's going to help offset those capital expenditures. The next one is again out of Georgia. This is, I think, Brazelton is how you pronounce that. It's 9 P&D routes. This is currently listed at 1.35 million, putting it right at 96% of revenue. This one's currently operating around a 14 to 15% EBITDA margin. This has assumable truck debt as an option. It also comes with 2 managers and 2 spare trucks. And this one here in Georgia could be a remote ownership opportunity for someone looking for a remote option. And it also has an improved fleet to help with efficiency and maintenance costs. The next one, again, out of that Brazelton, Georgia, this is another carved portion of that same business. This is 12 P&D routes. This one's listed at 1.65 million. That's putting it right at 101% of revenue. This portion is currently operating around a 17% EBITDA margin. Again, there's some assumable truck debt available here. This one's going to come with 2 managers and 3 spare trucks, and again, could be a remote ownership opportunity. Next one, again, out of Georgia, hot state this week. This is out of Norcross. This is a 12 P&D route operation listed at $565,000. This is right at 52% of revenue. This one's currently operating around a 10 to 11% EBITDA margin. It does come with one manager. It has low daily miles, again, to help with fuel costs. It's going to provide relief with other expenses as well. And it also has 2 spare drivers. That's going to be great for growth and contingency work if you're looking to do any of that. All right, so for line haul this week, we have something out of California. This one's coming from Rialto. This is 4 line haul runs. This is listed right at $875,000. That's putting it right around 78% of revenue. This is currently operating around a 14.5% EBITDA margin. It is comprised of 1 dedicated team run, 2 unassigned solo runs, and 1 unassigned team run. This is SBA eligible. This business is also coming from a contractor with 30 years of experience in the FedEx space. So very impressive there. And this owner is willing to assist with new driver training. So really, really good benefit there. And these dedicated runs are going to offer you a guaranteed source of revenue, while the unassigned runs provide an opportunity to accumulate line haul points. So if you're into line haul, this looks like a great opportunity out of Rialto, California. Next ones are actually Amazon listings that we have. This first one is in Sarasota County, Florida. This is going to be 30 DSP routes listed at 1.7 million. This is putting it right at 46, almost 47% of revenue, currently operating at a 15 to 16% EBITDA margin. This one is going to come with 3 managers. This is a very efficient operation with multiple managers in place to run the daily operations. They have been the top 25% of all DSPs in the network since inception. Very impressive. And this management team helped coach the company to the highest bonus every single week since it has been in business. So really, really great team there, especially the management team. That's out of Sarasota County, Florida. The next Amazon opportunity we have is out of Indianapolis, Indiana. This is going to be 22 DSP routes listed at 1.25 million. And this is right at 46% of revenue. This one is currently operating around a 13 to 14% EBITDA margin. It does come with 1 manager, large volume business in this territory. It's an efficient operation with multiple managers in place to help run those daily operations. They've had clean and consistent financial records with strong margins historically. And the current owner was the first DSP 2.0 to launch in this specific station. So lots of great stuff coming out this past week. If any of that interested you at all, please reach out to our team and we will get you more information.
Thank you so much, Bridget.
Yeah, yeah, take a quick breather there and cool down.
Perfect. Yeah, well, I will answer the question today while you recover.
Thank you.
So we did have a mascot. It was a bear. I was the DA Bears, Da Bears. He did dress in a full outfit. I think cooler than our mascot though is that we did have a set of parents who were hunters and donated a full stuffed grizzly bear in the lobby, like a 8-foot tall, like real bear that they had taxidermy and everything. And it stood in the lobby and has stood there for a long time. It originally was brown. It is now basically a polar bear because it also stood directly under a sunlight. And so it's gotten bleached over the years, but it's still very impressive.
Wow, that's pretty good. Mine is a little bit weird. Our mascot was a scarab. So if you don't know what a scarab is, it is a flesh-eating beetle. It really just looks like a ladybug. So
Can't
It's an
say
all girls school, so it
Yeah.
worked. But yeah, really, really terrifying.
That's great. I do not know many scarab mascots.
Yeah, we might be the only one. I certainly haven't heard of any other scarabs.
Yeah, perfect.
Yeah. We didn't necessarily have a mascot, but we did have someone during Spirit Week who would dress up in like little ladybug wings and run around, hyping everyone up.
Yeah.
Yeah. So, but no like stuffed ladybug like y'all had. I mean, that bear, that's kind of terrifying.
Yeah.
But impressive, I guess. All right, let's get to the Q&A and see what you all have to say this week. We'll get started from one. This is going to be anonymous, but we have a lion as a mascot, a classic. I feel like lion and eagle are pretty common. But he said the whole outfit for sure. But they always had a good dancer in the costume, so the mascot was always pretty legit.
That's nice. Yeah, I think ours is like a middle-aged parent who volunteered.
Oh my gosh.
Yeah.
That seems miserable. I feel like you get so sweaty and just gross.
He loved being excited for his kids and he wanted to show it. So
that is so sweet.
Yeah.
All right. So they want to know if you're paying a bonus for stops over 125, for example, would this be paid as a bonus or part of a regular pay on payroll?
So important qualification there, which I'll answer both sides of it, just for you to know. If they're in under 10,000 pound vehicles and so are eligible for overtime, it's different than if they are in over 10,000 pound vehicles. So if it is a true bonus that's basically always happening for anyone going over of that stop threshold, it would be a separate bonus category if they're not eligible for overtime. So if they're in over 10,000 pound vehicles, it'd be a bonus. But if they are not in over 10,000 pound vehicles, so you do have to pay them overtime, then the stop bonus has to be factored into their rate, which is then paid overtime on. So that's going to be the important thing there that you have to kind of calculate and figure out. If they're eligible for overtime and they go over overtime, regardless, it has to be calculated as part of the base rate.
Gotcha. All right, next one we have is from Yvette. Yvette says their school mascot was a badger. Go Badgers. She wants to know what is a good rule for percent of payroll expenses when you're comparing it to the overall revenue. What do we generally look for there?
Yeah, so we're looking for it to be in a range because it can depend on the state and certain things can factor into it, but usually between 35% and 55%. It is very rare to see anything at the 35% level. And if you're getting up to 55%, it's pretty close to being too high. So right in the middle there, mid 40s is kind of what you should shoot for. If you can be lower, great. But if it's too low, then you may not have competitive wages compared to the others in the area.
Right. Next one is from another anonymous. This one had a Mustang as a school mascot.
Well, now I got did they have a costume? Like, I've got to know if there was a two-person mascot team.
That would be awesome.
Yeah.
That'd be awesome. This one, I think a lot of people feel this one, this question. So he wants to know, we know margins are compressed with higher labor, fuel costs of trucks, but how have revenues / volumes fared during recessions or in times when the consumer is, as weak as the current readings? So, kind of market trends there.
Yeah, I'd say volume's pretty stable right now. But during 2020, during the pandemic, and what I would generally see as a weak time for the consumer, it did fare pretty well. That was a function as well of the lock-ins, but in general, we're not expecting 2020 levels of growth, but it's pretty stable volume-wise right now.
All right. Next one is from Jeff. Jeff said his school mascot was a panther. He said, this is really interesting. He went to the same school as Jeff Bezos went to.
All right.
But he said, I highly doubt Jeff was in the Panther suit.
Never know.
Yeah, that's awesome. He says in line haul, what is the benefit of using your own fuel card versus the FedEx T check card?
Yeah, so the main benefit of using the FedEx T-Check card is that it's really easy. Basically, you get all of your fuel is automatically logged. They handle all of that. If you're using an outside vendor, some of them will do that for you. So check and make sure that all of that same data will be logged automatically so you don't have to go through those admin steps. But there are others where you would have to file all of that information on your own, and it would have to go to FedEx and be a part of the statement. So if they're doing it for you and you're still getting discounts, great, because the T-Check, you don't really get many discounts other than that you're filling up at the fuel pumps at the terminal. But there are some vendor options where you will get the opportunity to still get discounts outside the terminal if you are on some kind of run where you don't get the opportunity to fill up at terminal pumps. So it's worth asking about. Just be aware of kind of the administrative headaches that can come from one that does not file back automatically.
All right. Next one we have is from Omari. Omari said his mascot was a Raider. Go Raiders. He said for every game, homecoming included the mascot suited up and always turned us up. He said he was a great hip hop dancer. That is so fun.
That's great.
I love it. Okay. He says, my contractor wants to sell me an unassigned run. Can we just sign the run over with the terminal manager, or is there more to it?
So yes, there's more to it. A couple of things for you to figure out. One, do you have any current runs? If you don't, and you're getting just one run, FedEx probably won't allow it. So just in general, the way it works in line haul is you have to usually have at least 2 runs to enter the space, because they're trying to avoid the old model of where one person could be an owner operator and just have a tractor. They want it to be more of a business. So if this would be your only run and you would be setting up your own separate entity, it's unlikely that they would let you do just one. It'd most likely have to be at least 2. For an unassigned run, it is a little bit more straightforward than a dedicated, but no matter what, if you are creating your own entity for the first time, you will still have to go through an approval process. And so FedEx will still have to approve your entity and you as the AO before they can assign you any runs. If you're already in the space and you already have runs, and there's someone who's just trying to get you to essentially sell you or give you an unassigned run, it is pretty easy to just basically get it switched between contracts once you alert FedEx to it.
All right. Next one we have here is from Ches. Ches says, we did not have a high school mascot. I grew up in Nigeria, and that was not part of our culture, at least back then. Understandable.
Yeah.
But he said his question is, I'm looking at an opportunity here in Texas. Payroll appears to be 57 to 60% of revenue. I know that's high, but I also see why it's high. Employee wages are around 43%, but bonuses are 14 to 17% of the total payroll. Could you speak about how drivers are compensated when they do additional stops?
Yeah, so there could be a bunch of reasons, and it really depends on how the bonuses are structured as to why there's such a significant percent. There are like plenty of people who just pay a daily rate and don't compensate for additional stops. There are some people who pay hourly and don't compensate for additional stops. It's just a function of how long you work. There are also those who pay it could be that for some employees, they're just getting paid a flat per stop payment. And then there are some people who have some kind of daily rate. And then once they go over a certain threshold of stops, they get paid an additional amount per stop. So there's lots of different ways you can bonus per stop. As to exactly what that seller is doing, I don't know for sure. And as to why it would be such a significant percentage, it could be that it's always built in that way, where they always have a decent percentage of the pay be bonuses, or it could be that for some reason right now, to incentivize additional efficiency out of their routes, they're trying to push their drivers to do more stops. Could be a couple of different things. It's hard to know without seeing some more data there.
All right. Next one we have here is from Alejandro. Alejandro says their mascot was a panther. The name was Pat, and he did wear a full panther suit.
Perfect. Love to see it.
Dedication. Yes, even with the name. He wants to know, what should the driver to manager ratio actually be? What makes sense there?
Yeah, so just general averages, when you get to about 8 or 9 routes, it's generally when we recommend having a manager. Before that, you can have one. It's just that the margins don't always support having the manager, but if you're comfortable giving up cash flow to have more management, that's fine. It's just a cash flow decision. There's not a true ratio, but I would say once you get to about 15 routes is where you would probably consider at least having a second manager. And somewhere in between 8 and 15 routes is when you're going to at least want to have someone who has some kind of lead driver capabilities, or it'll have to be you as the owner, because if that manager is not working 7 days a week, you may need somebody who can help out on the weekends. It doesn't have to be a true promotion where you're paying a bunch of extra payroll, but basically training them to be a manager by having them learn some of those managerial duties, and they can fulfill it 1 or 2 days a week on the weekend is something you should at least be working towards. Just since we're in a 7-day operation world, so you need management 7 days a week. So if you're not going to do it, start to work towards somebody on your team doing it.
Yeah. All right. Next one we have here is from David. David said their mascot was a ram, and yes, full garb. So that one's actually, I haven't heard ram yet.
Yeah, I haven't either. I'm curious what that outfit looks like.
Okay. He wants to know, what about other implementation expenses, such as industry software subscriptions, scanners, etc.? Is the industry seeing a slowdown in sales of spinoffs and or existing companies? And are there more available this year that are actually SBA eligible? He said last year it seemed they were primarily cash deals.
Yeah, so other implementation expenses, there shouldn't be many upfront expenses. A lot of those technologies should already be on the trucks. There are some vendors that have ongoing monthly fees, but that should be already factored in and a part of the financials and a part of what you're expecting in terms of monthly expenses. But there shouldn't be any additional startup costs there, as long as you're inheriting a fleet with technology already on it. As for actual, slowdown or speed up of carve outs, there's still plenty of carve outs, and it's still a function of scale and people being large and having to sell pieces of their business off, or they're trying to sell their entire business to retire, but they've gotten so large where they have to sell it in 2 or 3 pieces. I would say that them being a carve out does not mean they won't be SBA eligible. We have seen some more flexibility there on the SBA side. Definitely not going to guarantee it. It does make it more difficult, but we have seen several banks that have funded at carve outs. There's sometimes a higher level of documentation, but it can be SBA eligible. I also saw a chat pop up that reminded me of this. We have seen at least one bank who is open to reviewing Amazon deals for SBA eligibility. Again, can't promise it. We're still in the early stages there, but there's potential.
Awesome. All right. So next one we have, this is going to be a combination of questions, so I'll feed them to you.
Okay.
But this is from an anonymous attendee whose mascot was a raider. They said they rode on a horse as a Revolutionary War cavalryman. Very intense.
High school mascot. Yeah.
I like it. I like it. Okay, so they said, I'm going to buy a FedEx business, and FedEx has asked the seller to split it into 2 to sell it to 2 different people. Is there a way that me and my husband can buy these 2 separately? Is there a potential risk there? We'll just start with that.
Definitely risk. So if you and your husband share the same last name, if the terminal knows the 2 of you at all, it's very unlikely that they would allow you to buy it in 2 different pieces. The way FedEx does scale and the reason they force these splits is because it is a risk analysis for FedEx, where they do not want one contractor to be so large and such a high percentage of the terminal that if they are to fail, it would seriously damage the terminal's success. So these scale limits is they want everyone to be below a certain percentage. So if they are telling the seller that he has to sell it in 2 pieces, then it means that that seller is above that scale limit and is having to sell it in 2 pieces so that those 2 individual pieces are below the scale limit and going to 2 different buyers. If you were to buy it as you and your husband and you guys have the same last name, or the terminal is already aware of you two being married, then they will still view you as one buying entity. And so they wouldn't let you get the 2 pieces separately. There could be a terminal manager that would make an exception. It's really rare, and it still puts you at risk, because if someone at corporate or if a new terminal manager came along and you're a husband and wife team, they could easily tell you have to sell a piece. So what I would say is, if you are still interested in buying the full thing, it's probably that you would have to find some kind of business partner that is either not related to you, or maybe it's a cousin who has a different last name. And the important thing there is, in that process, both parties would have to be approved by FedEx, and you would have to demonstrate in that interview that you are not connected financially, or really what you're trying to demonstrate is that each party is able to function on their own and can get approved and be successful. And you wouldn't want to talk about, you wouldn't want to be related at all, really. You would want to be separate parties.
Gotcha. All right. Another follow-up there. What would be the average, if you can give us one, average CapEx on trucks per year for a 7 route operation that has 16-year-old, it's like a 16-year-old fleet?
16-year-old fleet, 7 route operation. So the big kind of factors there that would give you a real number. What kind of trucks are they? What size trucks, and what's the mileage? If they're 16-year-old trucks that are maybe for whatever reason they don't have very high mileage, that's one thing. If they're 16-year-old trucks with the expected 200, 300,000 or more on the mileage, then a lot of those are basically at end of life. The other big factor is, what is the mileage of the territory? If it's really dense and they're only doing 20 or 30 miles a day, those trucks are going to last a lot longer than if you have a territory that's doing 150 to 200 miles a day, where those are going to retire a lot more quickly. So it's hard to give exact numbers. If with 7 trucks, let's say, and it's probably likely, just based on the years, that at least 3 or 4 of them are going to need to be replaced. And if they're, say, P1000s, it's probably going to be like 50 to 60K per truck in a normal environment. It's a little bit more expensive right now, so it may be even more than that, but it's really hard to give specifics unless I knew the mileage and the type of truck and the mileage of the territory. So those are the numbers to get, and then kind of model out when you would have to retire them and think through what point in time you want to sell them. We will often sell our vehicles between the 150 to 200,000 mile mark, and we'll sell them and buy new again. Some contractors will extend the life out to 300,000 or 400,000, sometimes even higher if they're diesels or if there's engine replacements. But as you get higher in life, the CapEx, you may be keeping the CapEx lower, but your repair and maintenance is going to keep rising exponentially towards the end of the life of those vehicles.
Right. One thing that I've seen a lot that's been valuable in kind of figuring out the fleet value too, is having those maintenance records, like how many engines did they replace, how many, like all of those details too will help you figure out the value and how much CapEx you need to have for a fleet that age.
Yeah.
All right, next one we have is from Doug. Doug said, we were the Rams and it was a full body costume with a giant ram head.
Okay, that makes more sense than a full ram body. So
yeah. He wants to know, what are your thoughts on the Walmart and Amazon Q1 results? I don't know if you've looked at these yet, Josh, and how much of an effect on FedEx volume is impacted by the Walmart Plus.
Yeah, I haven't reviewed the Walmart results yet, but we'll see. It's one of those things that we look at. I'm not too worried about Amazon compared to FedEx. They're wholly separate. We'll see how Walmart affects things. That is someone that FedEx works with often and delivers lots from, but yeah, I don't have enough information to comment on the results right here.
All right. We have a follow-up from Jeff. Jeff was the Panther. He was part of the Panther mascot tribe. He wants to know, in order to determine the more profitable approach in line haul, is there a formula to apply on whether to go with financing or leasing a new or used tractor?
Yeah, so if you reach out to the team, we can talk you through some of the numbers and compare leasing and financing. In general terms, if you're in line haul, it often doesn't make sense to do a lease unless your solo run is above 2,200 miles a week, or your team runs are above 4,400. You can still do it at lower mileage, but it's just not as profitable at the lower mileage runs. So that's the first thing, is if you're not in those bands, it may not even be worth it at all. But then depending on a couple of things, we can kind of walk through the factors, but we have found in almost all of our fleet that's in those mileage range that leases are the most effective and most profitable, especially if you're thinking of this as more than just a 1-year business, because it eliminates the CapEx over time. So there's a little bit more upfront, but also your repair and maintenance is covered. You've eliminated CapEx, and it just makes the business as a whole more reliable, easier to replace trucks when they go down, to get fixes. You're getting new trucks more often, which also helps for driver retention and recruitment. So lots of positives beyond just the pure numbers comparing those two, but we can talk you through that if you reach out to the team.
Okay, great. This next one, I just have to say their mascot, because I think I mixed up an anonymous answer here, but we have the same question, and I think it's from the same person. We already answered it. This was about the FedEx business requiring them to split the business into 2, and can the husband and wife buy it? Okay, their mascot was a panda. A panda. That is awesome. Yeah. I want to see the costume.
That's amazing.
And like when you think of mascots like hyping up a crowd, you know.
Yeah,
like,
I can't even imagine. I would love that though.
I know.
I don't think it's going to intimidate anybody, but
Surely not. Yeah. Okay. So next question we have here is from John. John said his mascot, they were the Chiefs, and yes, they had a full outfit. He said different times back then. He wants to know, is there any advantage on the additional reporting that Fuel Z offers for the P&D, for a P&D operation?
Yeah, so we found that to be really important. There's a few different things on the reporting side that we have found to save a lot of money. One is on the reporting around fuel and fill up, in terms of when they're going to the pump, you can get automatic alerts for, you'll have a driver who will go up and get 120 gallons in the tank, perfectly fine, except for the truck only holds 100 gallons. So clearly he had some kind of friend or family pull up behind and get that additional 20 gallons. So we'll get an automatic alert to know when it happened, who it was. It's tied to the person as well, so that we can kind of get ahead of that and know if someone's stealing money from us. There's also alerts around if they have not typed in the odometer correctly after filling up. And we found that to be really important for tracking the miles per gallon on the vehicles. So if you're inputting the right odometer readings, then you know what the miles per gallon can be over time. And that's a data point we use to track the health of our vehicles, to see, okay, these vehicles look the same, but this one's doing significantly better on the miles per gallon. There's something internally going on. This is probably the one we're going to target for retirement first, or at least try to get fixed, see what's happening there. So it's a really important data point that you wouldn't get otherwise. And then just in general, comparing it to a credit card, or some that don't have as many controls, just the fact that they can only buy fuel from it is really important to just save on the little tiny thefts you get over and over from drivers who just get 2 different ways I've seen it, or going in and buying something inside and using the credit card, or I've seen people who will go in and tell the clerk they're going to pay $50 to fill up outside, and then stop halfway and be like, oh, okay, hey, I only needed 25. Can I just get the rest back in cash? It's really hard to track stuff like that on a credit card or something that doesn't have all the reporting and controls.
Yeah, that's apparently pretty common. Jesse says skimming is on the rise at all 3 major fuel type gas stations globally. And I can understand why, because of the price.
Yeah.
But yeah, it's going to be really valuable for your business to have something like, Fuelzy that tracks that, especially right now.
Yeah.
Okay, one from Gabriel here. I know you already touched on it a little bit, but are Amazon DSPs SBA eligible?
Yeah, that's the one where potentially we've got a couple in the works and a lender who is interested. One of the main criteria that we've gotten on that is that you need a 2021 tax return for right now, which there are some sellers that have not gotten those back yet, it's just that time of year where you haven't received them yet, filed for extensions.
Gotcha. All right, we're winding down now. If anybody has any burning questions they want to get answered today, please pop those in the Q&A and we'll try to get to them before time runs out. But we do have a few more. I will get to. We have one from Faraz. Okay, Faraz says, I'm looking at a line haul opportunity. I found one, but I feel the driver payroll is too high. He said about 38%. What is the range for these type of salaries in line haul?
Yeah, so let me first clarify the question earlier around payroll range. My answer was more on the P&D sides when I said 35 to 55. So appreciate you for asking this, giving me a chance to revise it. On the line haul side, it's going to be closer to 31 to 41% of revenue. So 38 is on the high end for sure. But it could just be a function of the territory, or it could be that because of the competitiveness for drivers right now, that they had to pay some extra rates or some kind of sign-on bonus or higher rate.
Great. All right. This next one is from Daniel. Daniel said, we were the Hawks and there was no mascot. That would be kind of tough. All right, this, Josh, I will be very impressed if you can answer this under 60 seconds, but he wants to know, he said, I'm looking at FedEx routes as a possible investment. What does FedEx require for new contractors to be approved to purchase routes?
Okay, so it is both
an easy
one and a long answer. So the first thing I'll say is we've got a 101 course on our site that's free that I'd tell you to go to after this, that we go in detail on a lot of those things just to kind of give you an overview. The very short things that FedEx requires is that you have to have an entity. It has to be an S Corp or a C Corp. You have to fill out an RFI, which is essentially a business plan. And then there's a couple little things around different taxes and things you have to apply for and be ready for. And then you go into that interview. If you are working with us, we will prepare you for the interview, make sure you're ready. But coming out of that interview, if you've provided all of those things and those documents, FedEx approves you, you'll then be moving towards a close. The really critical vendor that you also have to have before they will allow you to stand up as a contractor is you have to have your insurance set up. There's a couple little ones, but if you don't have insurance set up, they will not allow you to start. That's for the FedEx side. With the seller, obviously, you have to go through the contract. You have to have the contract signed, a bunch of different pieces there. But the main thing are what I already mentioned in terms of what FedEx is looking for.
All right, we have another one, a follow-up from Ches, who is from Nigeria with no mascot. He wants to know what sort of percentage of revenue should one be looking at for insurance? Do ISPs actually go over the daily stop threshold set in their contract? So two questions.
Yeah, so percentage of revenue for insurance is going to be somewhere around 3 to 6%. And that's a combination of physical damages and workers' comp and non-trucking liability, but that's a really small number. So in that range, it's going to fluctuate based on state to state, but also If you're inheriting a really good mod score from the person you're buying from, or if you're starting fresh, if the state has a high average workers' comp rate, it can vary there. What was the second part of the question? Oh, daily stop threshold.
Yes.
Very rarely, just about the only time you would go above it is during peak season. And so it's probably not going to have a material impact on your revenue throughout the year, but during peak season, it will. There's Schedule K. I don't want to get into all of that details. We don't have time for, but there's some things around. That's basically the only time of year that you'll go above it.
Great. All right, we have a repeat from Alejandro, whose mascot was Pat the Panther. He wants to know, prior to purchasing routes, would it be smart to apply for a line of credit for working capital if I am new to the business? Are there any lenders within the space willing to help new investors or contractors with securing funding when it comes to Amazon and line haul?
Yeah, so yes, on all of the above. Definitely banks that will help. We can introduce you to banks and lenders. They can help you fund the deal, and they are all interested in funding new buyers. It's going to depend on the deal, what documentation they need, but we can definitely introduce you to lenders who have done a lot of these deals. On the Amazon and line haul, separate FedEx line haul. Yes, we've done plenty of deals, still willing to fund. On the Amazon side, we do have lenders who are interested in it. We haven't done as many, but we do have lenders who are open to it, even though it's a newer space for them. So yes. And then you can apply for a working line of credit early. There are some banks that want to see additional working capital to be able to fund the loan. I would focus more on finding a deal and securing the initial funding first. You can work on a line of credit at the same time, but I think the biggest slowdown and biggest thing to find is going to be the deal that you can use, because the working line of credit is going to be nice. If you don't have any additional liquidity outside of a purchase, I'd say it would be really difficult for a bank to decide to fund unless you had some kind of working line of credit you could point to as additional liquidity, because it often is a requirement.
All right, great. We have just a few minutes left here, but I have some great mascots I want to get to, so I'm going to try to run through these real quick. First, I think this is a great question. He didn't put a mascot, so I'll forgive you for that, but this is from William. William says he's looking at a route business and the seller does not want to provide tax returns or financial statements for the company, only settlement statements, fuel statements, payroll, etc. To build up the estimate. Is this acceptable? Is this something that we can work through? Any advice?
Yeah, we can use that. And a lot of times those are the most important pieces of data. So for us, what we've seen is that the most important data for determining what the business is worth right now is all of the information from the last 8 weeks. It can be really useful. And if you're financing, you're definitely going to have something to see the historicals. It's important to just kind of see trend lines in the business and understand where certain expenses fell. But when we're pointing towards what it's worth right now, generally the last 8 weeks of data is the most important thing. We did a whole webinar on this a few weeks ago. If you want to kind of see about what's important on the tax return side, why it's okay and why it's not okay to have them. But in general, I would just say if you're financing, that's going to be a big challenge. Is if they won't provide any financials, it's going to be tough.
Yeah, exactly. All right, next one we have here. I have to read this. They said, well, first, thank you for your time. Josh, I'll say that's probably directed towards you. You always do a great job on these webinars, so thank you. But they said they were the Yellow Jackets, full-on mascot with tentacles and all. They said, hats off to those humans who wore it in the Texas heat. Holy cow. Yeah, I don't envy that. They want to know what other key ratios would be, should they be looking at when they're looking at buying a P&D operation? Yeah,
so we covered a lot of them. The biggest one's going to be payroll. That's always just going to be the biggest chunk of your revenue. Fuel, generally, I would say between 10 and 15%. There are some that are higher right now just because of fuel rates. Other important one really is on the equipment maintenance and rental side. Generally, we see it between about 9 and 15%. If it is really low, it should only be a scenario where they bought a bunch of new trucks and there's maybe warranties still on it where the repair maintenance is low. If it looks really low and the trucks are old, the only justification that I would accept is if they have either a mechanic on staff or a mechanic close by that they have really good rates from. So that's just something to confirm if you see really low, like 1, 2, 3 repair and maintenance and the vehicles don't match it.
All right, last one before we close out today. I had to get to this. This one's from Mary. Mary said their mascot was Shamu the whale. Are you kidding me? That is awesome.
That's so
Full costume. It was there. I'm gonna look this one up as well. It's too good. Also, maybe are you in Florida? What? Surely you're not in like Utah or something. I don't know. Yeah. She wants to know what fuel cards would you recommend work best for your companies. I know we talked a little bit about Fuel Z. We suggest them or anyone else.
Yep, Fuel Z is great. There's some others like WEX and plenty of there are lots of local fuel cards that I've seen be really successful for contractors. But Fuelman's another one too. Those are all good. But yeah, that's where I would start.
Great. All right. Well, thank you all for letting us take over the webinar this week. We got to most of the questions, but if we didn't get something answered for you, be sure to reach out to our team. Josh, it's always a pleasure.
Yeah. Oh, one thing too, I wanted to make sure for those of you who are looking for additional guidance or advice on Schedule L and those changes that are coming out for contractors, we did just put out a new blog post on our site. So go look at that and kind of get some updated info there.
Great. All right. Thanks, guys.
Perfect. All right. Thanks, everybody.